what I want is for entrepreneurs to get the exit that they deserve, um, not the one that they're left with. And I think often the entrepreneurs get the ones that they're left with because no one told them. No one gave them that advice 20 years before. And if someone would have told me, oh, if I'd have known him like that, all I had to do was X, Y, Z, I would have done it.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?
Hi, everyone. I'm Jason Balara, and this is the Know Your Why podcast. Today, I'm here with Saul Cohen. Saul is an experienced accountant and acquisition advisor, passionate about helping entrepreneurs achieve financial growth through strategic acquisitions. So, Saul, as I mentioned, there's a lot of impressive stuff in your bio, but I'd much rather have you kind of tell your story, and we'll dive into, I'm sure, a lot of it, and we'll get to learn more about you. But first, thank you for coming on the show today. Thanks for taking the time. I'm very excited to chat.
Yeah, I'm looking forward to it. Okay, so let me jump in, I suppose.
Yeah.
So I was, I suppose it starts actually when I was sort of a teenager. Really, I've always been someone who's inspired by entrepreneurs. I think my dad was he'd run his own business, and I I always appreciated the work that it took to run your own business, but also was just really inspired by, just the creativity and sort of drive and focus that it needed. But yeah, my dad was sort of an immigrant to the UK, and as is common often, he sort of pushed me very much down the path of academia. And so I sort of did reasonably well in school. I it, I was again, because of the fact that I enjoyed entrepreneurship, I was really drawn to economics. So was lucky enough to have a really inspiring economics teacher, which gave me even more of an appreciation for the value that entrepreneurs bring to the world. And I think more than just knowing about the value that the entrepreneurs brought, actually studying economics in more and more detail gave me a greater frustration for politics. And so I very much look at it as, entrepreneurs are the people who keep the economy going, they drive us forward, and politicians are the ones who restrain us and hold us back. I mean, and I know that's not always fair and it's not always the case, but just that's very much from studying economics and seeing how politicians have sort of, utilized economic theory for their own gain. That it's a massive frustration, and something that I sort of developed over time. I think when I got to uni, because of the fact that I'd always been so focused um, on academia, and when I was in school, I used to sort of sell stuff here and there. But when I was at uni, I really got frustrated about the fact that in my head I was 21, and I'm like, I'm 21 and I've done nothing with my life, which in hindsight seems a bit silly, but that's how I felt. And so started a business while I was at uni with a couple of other friends, and it was one of those. It was a really good idea, but we just were not the people to operate it. We just didn't have the experience or the maturity to really execute it. And I can only say that it was a good idea because at the time that we did it, there was someone else who did almost exactly the similar business, and he started, seasoned entrepreneur, and he sold out sort of 6 years later for 14 million. So clearly he'd done something that we didn't, and that, to be honest, that comparison was a really good, great lesson for me. So then after I'd sort of done that, I went to PwC, I decided I was going to be an accountant and learn from entrepreneurs if I can. The place that I saw in the world, obviously with my background in economics and everything, I was looking at, okay, if I'm going to do a career, what career will put me in front of entrepreneurs in an environment that allows me to A, learn from them, and B, be part of their journey. And I looked at that and thought, accountancy is perfect, and jumped into the world, worked at PwC, loved the work that I did when I was there, representing some fantastic clients, and because of the environment that I was in, and the office that I was in, um, we weren't sector specific. So I had clients from JP Morgan to EasyJet and everything in between. So banks, airlines, and shopping centres. It was really interesting, and managing to do some really interesting work, and learning from, in my opinion, probably the best, or at least certainly one of the best consultancy firms in the world. Um, but I think if I come back to sort of why I became an accountant, it was very much to work with entrepreneurs, and I felt that that was quite disconnected while I was at PwC, and so I decided to leave. Um, and I left initially. I took on a role at BT, which was just a little bit more flexible and allowed me to start my second business, if we call it that, which it was at the beginning, and then left once that business had got to a certain size. I'd sort of left, and originally it was just about providing a broad range of consulting services that I provided at PwC in a package that was sensible for entrepreneurs. But over time, just because of my experience, I developed a little bit of a niche in sort of acquisitions, and I've really understood that world, and it made a lot of sense. And it also sort of tied really well into the work that I'd done at the beginning of my career. And so yeah, that's sort of the journey that I went through. Um, and yeah, now we run the team. There's about sort of seven of us. I say about seven. There's seven of us sort of full time, and then there's a few other consultants who we sort of draw on because a lot of our work is project based. So sometimes we can have sort of 15 people working in the team, and sometimes it's just seven. So yeah, but and we do sort of that work for our clients, sort of buy side and sell side. Um, my view of the entrepreneurial journey is that entrepreneurs come in, they set up, they start working with a consultant, hopefully develop a bit of a tax plan, and then look to scale through acquisition and eventually prepare their own business for an exit. And so that's how we fit in, and I love the work that I do. I work with some really incredible people who aren't just really driven, and ambitious, which in of itself would be impressive, but normally are people who really want to make an impression on the world and leave a bit of a mark as well, which is, for me, it's what an amazing thing to be able to get up and help those sort of people every day.
Yeah. Yeah. No, I mean, the sort of closing piece of that, I think, is a important component, and will I think focus a lot on that because I love that message. But I mean, there is a very cool story and a couple things that that struck me. And the first one is just, it's funny how I've talked to a lot of immigrants who they're maybe like either first generation or born in or maybe their parents moved, but regardless, it's funny how the parents moving to a new country, typically setting up a business, like very, very entrepreneurial, always want their kids to do something very specific in go to school, become a doctor or a lawyer, or the kind of like very sort of traditional track. And it's interesting. I'm not sure I understand maybe why that would happen, like why the the parents would take maybe the biggest entrepreneurial move that they possibly could, in that they're, uprooting their lives and moving to a new country, and then want their children to kind of stay on the stay on the straight and narrow, if you will. I don't do you have any sense, or have you ever talked to your parents about why that would be?
So yeah, actually, it's interesting because you're right. It is really common, um, and loads of people from those sort of backgrounds, whether it's Jewish people with those backgrounds or Asian people with those backgrounds. Everyone's got sort of, as you say, there's a similar approach.
Yeah.
Um, I think it's a little bit. I think entrepreneurship is hard,
Hmm.
um, and a parent is always concerned about their kids and they always want more for their kids than they have, right? They always want their kids to be moving forward. And I think, particularly in generations gone by, um, there was this attitude. Absolutely, these people, they were really entrepreneurial, they were really driven, they wanted to um, create a better life for their family. Everything was about creating a better life for their family. But the academic world offered much more stability, and it offered much more, not only stability but actually a more comfortable life. If you achieved well academically, you would probably go on to have a more comfortable life than just standard entrepreneurship, and have that with a lower degree of risk and uncertainty. And I think that's why, certainly our parents in their generation were very driven to sort of say, we had all this um, uncertainty and risk in our life. Yes, we might have achieved, but you can achieve even more and have less uncertainty and risk. Why wouldn't you do that? um, I think the funny thing is that in I think that held true for many years, hundreds of years. But in the past sort of 20 years, so exactly the period that we came into the sort of working world, the world actually changed a little bit, and you know the value of academic success has, I think, in terms of life quality of life, has reduced a bit, right? So,
Yeah.
if you think about the payoff for academia is certainly not as high as it used to be, let's say 30 years ago. Um, and I think that, combined with the fact that we also have, high other expenses, and the world is inherently uncertain at this time, actually the payoff is for entrepreneurship is sort of increasing, um,
Yeah.
and I think that's why it's sort of changing a little bit. But absolutely, I think that's why they were drawn to this sort of academic world, because it was risk free.
Yeah, I mean, it makes a lot of sense that the risk reward, or at least the perceived risk reward, especially 20, 30 years ago, was far more stability through, standard education and things like that. But I agree, it's not. I don't know that that's the case anymore, and I think that it's always hard to say. It's always hard to decipher whether or not, there are more entrepreneurs, or people are more entrepreneurial, or we just have social media now, so we hear about it. And like, I feel like you could make that same question for everything. Basically, it's like, oh, here's these things I never knew about before, but do I know about them now only because access to information is so much more readily available? And so I guess I don't know the answer to that question, but you you said something else, kind of, when you were talking about your background, where you thought the best thing to do is to be around other entrepreneurs and kind of experience their world. And I think that gets said in a lot of different ways. You are the average of the five people you spend the most time with. There's all kinds of things out there, cliche, that spread that same message because it's true. Um, and one thing that I've noticed in talking to people on this podcast is a lot of success with the um, apprenticeship model, which is, if we talk about historically, go back 30 years again, that was pretty common. You would apprentice with someone to sort of learn and master a craft. It's not so much the case, or hasn't been, and I wonder. I often think it should be. I think what you just described is like getting in the place around these other entrepreneurs and finding a way that you can provide value to them to learn what they're doing is such an underrated path that makes a ton of sense. I wondered if you would talk a little bit about that and like maybe your response to what I just said, if you know kind of how that played out with your career path.
Yeah, it's funny because I was talking with a vet today on LinkedIn just literally this morning, and he said to me that in his generation there were people would go out exactly as you said. They'd take maybe a Saturday job, or like part-time jobs, just to sort of, even if it's just making tea and coffee, but to understand an industry and be inspired by people. And he thinks that that's happening less now. And we were sort of having a bit of a discussion about, is that because of us as the working people, the adults of the generation, because we have our own perceptions and therefore are restricting those opportunities, or is it from the youth of today where they've got different aspirations, different hopes and dreams, different value systems in many cases, and just better alternatives, right? When we were kids, there certainly wasn't as much entertainment available as there is today. And I don't know the answer to that. I think it's probably, as with anything, a combination of all of the above. Um, but I think that osmosis is a really powerful and inherently undervalued thing. And I think that we live in a bit of a funny world because we are on the verge of. I think we as a species, like human beings, we haven't really decided how we want to react to the digital age in many ways, and I think it's forcing us to really appreciate what makes us human. Um, and we definitely we saw this massive push towards, oh, let's work remotely because we've got these digital tools to work remotely, and that's going to be amazing. But I think when you work remotely, you lose the value in that osmosis, because you know there's one thing deliberately having a Zoom call to speak about a specific issue, but the osmosis doesn't happen when you're talking about something specific. It happens in those the coffee machine chats, or just over the table, short chitter chatter, and that is being lost. And I think as a yeah, I think humans are starting now to appreciate the fact, or at least become more conscious of the fact, that we need to prioritize relationships a lot more. And as much as the digital age enables us to enhance relationships, if we allow it to, it will also destroy relationships. Um, and I think therefore, um, as time progresses, I'm hopeful that we come to a better equilibrium and a better way of working and making that work. But yeah, I think it comes down to that point, really, that we're just undecided about how to react to the digital age and make the best out of it.
Yeah, that I think that's a fantastic point because you you could for most people, well, most people I don't know, but basically the digital age has been around for probably not as long as we think it has. Like technology changes so quickly now that you feel like, oh, I'm evolutions of this, some particular technology down the road, it must have been around for forever, but it really hasn't. Like the example I like to use is iPhone came out in 2007. Like it hasn't been 20 years that we've had iPhones.
Right.
And it's like we now, most people, you can run a business from a phone, right? You can run a business digitally. You have so much access to information. I think you brought up politics at the beginning, just and I don't mean to get into a political discussion, but I think one of the issues that is currently in politics is people are coming up with solutions, historical solutions to problems that are based on a world 50 years ago that is not what we have right now. And just the fact that we have such quick and easy access to information changes everything. Like it's like, you see all this economic data coming out. I mean, in the US anyway, like all this economic data coming out because of a tweet or some soundbite from a thing, and it's like, oh, someone said something, sell all of this stock. Like it's just, and it's like you wouldn't have known that even probably 20 years ago, maybe less than that. Like you wouldn't have known those things in real time. And I think that you're absolutely right that have not we might think we've figured out how to navigate this, but like it's changing so quickly, we don't, and we have effectively a generation or generations of kids that don't really know how to talk to people
Yeah.
because they don't have to. Like it can all go through their phone or computer or whatnot. And so I think I really agree with what you're saying there. That point that like we're still figuring this out. We're still figuring out how to like be human in a world that no longer necessarily requires you to be human. You now have to do it because you want to, not because you have to. I think is a little bit. It's just a little bit of a different angle on that. So I mean, it's a fascinating time, but also like recognizing like it won't be the same in 10 years. It really won't be the same in 20 years. Like and just how quickly things are going to change, I think is a big piece of, I guess, understanding how to approach it right now.
Yeah. I
So
mean, we don't even see people planning for 10 years anymore.
yeah,
We used to see that all the time. People would do like a 10-year plan or whatever. You know, it's rare to see a 5-year plan these days. And it's exactly as you're saying, because the world is just changing at a faster rate than it ever has.
yeah, yeah. So Saul, with your current business, you said it was mostly project based work, and I know it's a lot. Your bio mentioned kind of in the acquisition space. So tell me a little bit about kind of what exactly you do, your business model, all of that, so people can understand and I mean, obviously, best case scenario, connect with you and get to work with you. So what is that? What is that? What does that process look like?
Yeah. So, look, I mean, at our core, we're an accountancy practice, and we were set up just when I set up, I wanted to bring the value of sort of the big four into the SME world, and that was that was my dream and my ambition. And then I realized that actually that's quite a big thing to do on my own. And the big four are the big four because they've got a wealth of expertise and skills set that they have. And the other problem with working in the SME world is that generally it's one accountant who will own the relationship with the client. But the thing is that my view has always been, you might say, I think there's like 22 real niches within accountancy.
Mhm.
There's tax, there's corporate finance, there's cash flow management, there's internal audit, and all of these things are really important for the right stage of the business lifestyle cycle. But yeah, businesses, businesses don't have the budget to employ someone to do all of those things, and so they'll rely on their accountant. And often, what happens is they get quite frustrated with their accountant because they might have come to their accountant for tax advice, but their accountant is useless at giving them cash flow management, for example. And they don't necessarily understand this. So we transitioned the firm a little bit. We work with a lot of outside partners on the areas that we're not good at. And I sort of said, you know what, let's just niche down in terms of in what we're really good at. So we have sort of that sort of tax management and accountancy arm, the compliance branch that we do provide for our clients, which is the standard accountant recurring model. But more and more what we're doing is supporting clients with sort of making acquisitions and group rollouts. We are now starting to see more and more recurring revenue around that. So retainers on, based on consultancy around the building out of that group and building efficiencies into that group. And then again, we sort of do a lot of consultancy with exits, preparation for exits, because I think people miss out. People just aren't aware of what it takes to prep a business for exit and where the value really is, and understanding valuation and all of that stuff. So we sort of come in, we do an initial assessment, like a due diligence process, make the vendor aware of what to expect when they actually do come to sell their business, but with the massive benefit of having time to go out and fix that job, or fix the business and fix everything in our due diligence before they come to sell, so that when they do come to sell, all the major risks have actually been addressed, and as a result they see sort of larger valuations. So that's sort of beginning to end the life cycle of our work with clients. But we've got various products within that we offer to clients both in the UK and abroad.
And what size businesses are you typically working with?
Yeah, it's a great question. So that's really where we niche down. So our clients exclusively come in to us and start working with us in the sort of 1 million to 5 million range revenue. So that's, yeah, I mean, it doesn't really make too much of a difference if it's dollars or pounds. Really, it's the same, that sort of
Yeah.
size. Most of our clients are a little bit bigger than that, because generally what tends to happen is they'll come in to us at that range, they'll make an acquisition or two and quite quickly get beyond that. And we are seeing people, we do prep clients for exit at a slightly higher, well, yeah, at higher valuations, way beyond that. We don't deal with acquisitions really below, above £20 million. And the reason why, and that's in revenue. The reason why we don't really go beyond that level is that the type of buyer and the structure of the deal is inherently different. And so everything about the process changes. And so our niche, where we're really good, is about making the acquisitions at that level, prepping the business and wrapping it up. And if for our clients who are going to sell out for, we've got one now selling out for 35 million. We've prepped them for the exit. They've got everything ready. We've prepped their back end, helped them with systems and processes, all of that fun stuff. But we'll probably give them, a recommendation for a bigger firm to work with on the actual sale, because the terms, everything is really different. And the thing about M&A is it's there's so many moving parts that it's much better for us to really niche down and just get that area really right, rather than try and do everything and you don't have those specialist skills, and you end up missing something for a client. And I think that's where a lot of people miss out, because really at the end of the day, it's about adding value to our clients, and sure, we get paid off of that value that we add, but really the more value that we can add, the better it is.
Yeah. And I just, for people listening, maybe clarify a couple things. And you're saying, I want to dive into that sort of prepping for sale piece, because I maybe most people listening might know, but if they don't, I mean, ultimately, if you can essentially businesses are sold on their profit, whether you're small, you're using SDE or EBITDA on a larger business, but they're sold on their profit, a multiple of the profit. So every dollar when in its prep process, I would assume like every dollar that you can sort of move onto that profit line, it doesn't end up in a dollar of sales price. It ends up in maybe $4 or $8, you know what I mean? Like depending on whatever the multiple might be for that business. So
Mm.
um, I that prepping for an exit, I think, is a huge piece. I've heard people talk about it like, oh, you should always uh, act as if you're going to hold the business forever, but at the same time be prepping for for making that exit look as good as it could. So how long how long do you typically recommend for a uh, prepping for that exit? Because like I'm looking to acquire businesses, I'm looking probably a similar range size wise, but when you'll look and it'll be like, oh, our profit is very very low, and then the year before we sold it's suddenly it's double or triple what it's been, and it's like, I know why. I know that seller is now trying to, they knew they want to sell, and that was their prep, is like a year. Let's make it look good that we and it's not so much that the business changed that much, but probably they, where things are being placed. But I wonder if you would maybe talk about your recommendations for, when you want to start prepping for an exit, and a little bit of what that looks like.
Yeah. Okay. Look. So first of all, I think that the ideal time to prep for a business exit is the day you start your business, right? And it's to build a business that's exit ready from day one. Um, the fact of the matter is that most people never do that, and so the next best time is today. Um, you know, there's never really a latest time because there's always things that we can do in
Yep.
advance, right? So, the quickest win that we will normally do and normally find is that they've got an issue with, the quality of their accounting records and the underlying accounting records. I would say 80% of businesses have this. They have an issue with the quality of their underlying accounting records. 80% of SMEs, I mean.
Mhm.
Um, certainly that we come across. And just fixing that will make the deal more likely, maybe even increase 10-20% of the value of the business, just because it reduces the risk. So it's never too late, but it's also never too early to start thinking about an exit, and I think that's really important. I think the next thing really is to understand valuation. I think, look, because I think that lots of people get thrown by these red herring valuations, like Tesla, for example. Its income is one thing and the valuation of the company is miles and miles above. And people don't really understand why that valuation is there, and therefore it becomes quite difficult. But actually, the reason why the valuation of Tesla or Instagram is where it is because there is a particular asset in that business, be it the data, um, be it the IP that's been developed, be it the batteries that have been developed, that an investor looks at that company and says, this business either has today or will have a significant competitive advantage in the market and will be making super normal profits later on. Or will, yeah, right. So the the valuation of a business really is the income generating potential and the risk that is assessed on the business. Now, in most SMEs, it's really hard to know what assets there, right? I am valuing assets, but they're all not tangible assets. They're all intangibles. They are the way you work, the relationships you have, the clients that you work with. And so the best way that we can value this, the easiest way that we can value it, is by taking the cash that you generate, i.e. your EBITDA, um, and assess and basically applying a risk multiple on that. So that's your multiplier. And the less risky it is as an investor, the lower return I'm going to be willing to take on investing in this business. Now, you're an SME business, so you're inherently risky. So it's really unlikely that I'm going to want to see less, than 10% return. So you're not going to see a 20 times EBITDA multiple in the SME world, or it's really unlikely to see that unless you've developed some particular, groundbreaking technology. You're probably going to see something in the region of a 3x, 5x, time multiple, and even less than that if the business is heavily reliant on you, for example. And so I think that's the next thing to do, is to really understand, how valuations work. Um, and then the third step would be to understand how valuations will work in relation to your business. And I think most business owners are inherently bad at that because they see their business as their baby, and they find it very difficult to take a step out, and look at it as an investor.
Yeah, it's it's actually something that I've come to realize after investing in real estate, buying real estate. It's very, very transactional. But then when you start talking about business acquisition, it becomes much more of an emotional type of process, because it is, like you said, like a lot of people look at that business as their baby. They've owned it for 20, 30 years. It's and it's the people are there that work there are their family. And I mean, there's a lot more that goes into it from an emotional standpoint. And I think it's an interesting, it's good for the business in a way, but also I think sometimes for some of the reasons you just talked about, can reduce their valuation at exit, because it's so reliant on them. It's kind of they built it around this a lifestyle, I guess, type business, rather
Yeah.
than one that's looking at it from a pure profit standpoint. Which it's not a bad thing. It's just a thing. So yeah, it's I think the points are well taken. You need to, again, start be prepping for that exit from day one. But I would guess, correct me if I'm wrong, when you say that it's more about appropriate record keeping, essentially, like you said, having your financials be kind of well documented throughout, or is there more to it that you would look at straight from the beginning?
No, so I think there's more to it. So I think, okay, so first of all, to your first point, I think actually that the SME acquisitions, and this is important to know for any investor in the market, it's actually more heart than it is head.
Yeah.
And it's yeah, right, people think, oh yeah, fine, so it's probably like 50-50, or okay, so people are just going to be emotional around the numbers. It's nothing to do with that. And I've seen people take 30% lower transaction value because they believe that the buyer gets them and understands the business and they connected with them on an emotional level. And so it really, really is more heart than it is head, and managing a seller through that process is more about giving them sort of counseling than it is about giving them the financials that they say they want. I think in terms of coming back to your point about prepping the business, I think it's like with anything, right? If I have to start looking for why this business is valuable, then the business is inherently less valuable because it's not
Sure.
consciously aware. It hasn't achieved, consciousness about the things that it's doing well. But if you can tell me the specific inherent assets that you have developed in your business, the ways in which you work, your systems, processes, and controls, for example, what you've built in your brand and what that brand is worth, the genuine reputation that can be backed up by numbers. Not necessarily, doesn't have to be numbers within the accounts, but it might be numbers that show the level of inquiries that you have into your business, the high value relationships or high value contracts in your business. If you can point to those assets and you're confident about what those assets are, point to them and then evidence those assets to an investor, obviously that makes your business much more attractive. If it's much more attractive and it's easier to demonstrate the value, I'm much more willing to attribute a higher valuation to it, and definitely much more interested in making this purchase. If I have to come into a business and see, it's making 150K, but I have absolutely no idea where that money is coming from, or how this money will come in post the seller leaving the business, the business is inherently less valuable, because the seller can't even articulate where that money's where the business is going to continue to generate the income from. So I think a lot of it is just having that conscious competence around, we're very good because of X, Y, and Z.
Yeah. Yeah, that's I don't know that I've heard it articulated that way, but I think that makes a ton of sense. And just knowing the value proposition that you provide, like why would someone continue to not just buy this business, but like why would they do business with this business? Because that's ultimately what an investor wants to determine when they're looking to purchase a business. Like, okay, I don't want this to fall apart the day I take over. Like, what's here that's good for me to kind of work from. So, yeah, I think that's a great point. Um, well, Saul, I want to I don't want to run through the whole day. I could ask you a million questions on this. So it's a very fascinating topic to me. So, what I want to do is kind of shift gears here a little bit. And the first thing I always ask every guest, the name of the show is Know Your Why, and I think you've talked about the journey a lot, kind of to get where you are, and wanting to be in and around entrepreneurs, and now you've become an entrepreneur yourself. I'd wonder if you talk about kind of what's your why now, what's driving you, what kind of keeps you motivated on a daily basis.
Well, look, I think the first thing is to give, and this is a big part of why I do these podcasts, and I'm writing a book, and the reason why I want to get my message out to the world is I want entrepreneurs to be prepared, right? Because I think that entrepreneurship is really hard, and it's fun and it's exciting, but it's also really hard, right? And entrepreneurs make a lot of sacrifices, and they get a lot of benefits for those sacrifices often, but they do make sacrifices. And what I want is for entrepreneurs to get the exit that they deserve, not the one that they're left with. And I think often the entrepreneurs get the ones that they're left with because no one told them, no one gave them that advice 20 years before. And if someone would have told me, oh, if I had known him like that, all I had to do was X, Y, Z, I would have done it. I just didn't know that. And there's no school for entrepreneurship. And, I'm definitely not a seasoned entrepreneur enough to be able to teach in that school, even if there was. But I do know about this specific area. And the more that I can educate entrepreneurs on that so that they're prepared for it, to me, I think, that's amazing, because in my experience, all entrepreneurs care about making an impact. And they make a positive impact on the world, and they generate value, and I really do see that. So I think that's my biggest why, in terms of why I do what I do the way I do it. But yeah, obviously it's, as with all entrepreneurs, right? I'm driven by my own selfish purposes. I want to provide for my family. I want them to have you know certain opportunities, even opportunities that I didn't have, better, bigger and better opportunities. And I'm driven by supporting my community, my local communities in ways. And I get a lot from giving back to people, and talking to young kids about entrepreneurship as well, and supporting them on their journeys. And I think that's probably quite similar with a lot of entrepreneurs, certainly the ones that we work with. But yeah, absolutely. That's what gives me my drive and my buzz to keep going.
Yeah. And I mean, you said before, entrepreneurship or small business ownership is more heart than, or yeah, more heart than head. And I think that's, you just said, like, a lot of people aren't told what they needed to do to have that better exit. And it's just, it's an interesting, I don't know, just the seller versus the buyer investor. That buyer investor, it doesn't have that heart part of the business yet. They are going to be looking at what is on the paper, right? Like, what is on the the financials that they're provided. That sure, they want to hear the story and stuff, but yeah, I think the business owner, the seller, is going to be very, very good at providing that heart, and then you can come in and help them really also sort of I guess even it out with a little bit of the head, in the sense that they can have a better position from which to demonstrate their value. And so I think that it is really, really an important piece here for people to kind of understand, honestly, on both sides, right?
Yeah.
As the buyer or the seller. Like, that was, I mean, really, for me, what I've been struck with so much in that small business acquisition role is just how absolutely right you are, that it is much more heart than it is like, oh, here are the numbers, right? And so it is an interesting and kind of really fun space to be in, I think, in navigating those pieces. So I love that service that you're providing, kind of marrying the two. So when people hear this and they want to connect, maybe work with you, what's the best way for them to reach out?
Definitely on LinkedIn. So I'm posting all the time on there. So LinkedIn is absolutely the best way. I've also got a book coming out, so I've got a wait list for that, when we'll probably be dropping in the run up to the launch. We'll probably be dropping some free chapters and snippets and stuff and goodies in there as well. So yeah, definitely either of those two. But yeah, I'm posting stuff on LinkedIn all the time. So.
Okay. All right. Cool. Well, we'll get your LinkedIn in the show notes for people to find you. Saul, this has been great. Thank you so much for coming on the show and sharing all that you did. I think this is really, really an important topic for people, again, on both sides, business owners and, people who are wanting to acquire businesses. There's a lot here to be applied to, kind of whatever side you're coming from. So thank you again for being here today.
No, thank you so much. I've loved chatting. So yeah, no, it's been fantastic.
Awesome. Folks listening, make sure you connect with Saul, especially if you're looking to, acquire or sell a business. Please like, rate, and review the show so we can continue to get great guests. And as always, thank you for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?